All right, guys. This is just going to be, you know, a price action lesson. That's what we got going on. I'm going to talk a little bit about the new hot topic, candle range theory. It's nothing but a turtle soup going from buy side to sell side, premium to discount, internal, internal liquidity. That's all there is to it. But in order to do it on these higher time frames, you have to know what type of market condition we're currently trading inside of. So in the past 12 plus months, what has this market been doing on this higher time frame, which is a monthly chart? What has price been doing, guys? This is Euro USD. We've been trading, we're very, very tightly on this monthly chart. It's been a nice tight range, a nice consolidation. Okay. So the market's not looking to break out higher and it's not looking to break out lower. So we're trying to confirm our market condition. Okay. When you're in a consolidation, you always want to note the dealing range high and you want to note the dealing range low. When you have that identified, we're going to go ahead and draw a line right on the 50% level. Because what the market wants to do is it wants to take out buy side, it wants to take out sell side, and then after it does so, it always wants to reprice and draw back towards that 50% level, and it acts as a magnet. There's like a magnetic pull on price action. When it's in a deep discount and then it takes out sell side, it's going to want to draw back to equilibrium. Okay. When it's in a deep premium way up here and it takes out buy side, they're going to want to draw back to equilibrium and then hang out and then go back to discount, take out sell side and then draw back to equilibrium, consolidate, and then take out buy side liquidity and then head up into a premium market and then draw back the equilibrium. And they're just going to do that. Okay. That is the current market condition we're in when it comes to euro and the dollar index. And here in a little bit, I'll go back over to dollar and I'll show you what I mean on that chart as well. So right now, first things first, we are identifying what type of market condition we're currently involved in. So we've already come to realize and accept that we're in a consolidation. And we already noted our dealing range, which was this high down to this low. This red line is nothing but the middle. It's the center point. Look how these candles are acting with that level also. Look at the bodies here on these ones. Note how they're all closing below it just perfectly. Look at the wick on this candle. They tap it. The body on this one, very close. The body on this candle, below it. And then they're playing with that level up in here with the wicks. And the farther down you go in your time frame, the more relevant this red line is going to be. All right. So that's our first step. What type of market are we involved in? So we already came to the conclusion that we are in an overall consolidation. We have our equilibrium point. So when we're in a range market like this on this monthly chart, we're not expecting a breakout above the overall high, and we're not expecting a breakout down below the overall low. We don't know when that will happen. All we know is we're in an overall range consolidation. We're not looking to catch expansions above the range high or the range low. Every time price is above this red line and it takes out buy side, we expect it to come back down to equilibrium. Every time price is below this red line and then takes out a form of sell side, we expect price to go back to equilibrium. With that said, when we drop down to the weekly chart, we have price right here a couple weeks ago, back in March and April. Price was hanging out right here at this red line, which is equilibrium, okay? I told y'all price is going to hang out at equilibrium, just like this, They're going to take out sell side liquidity. Where is the sell side liquidity at? Below this low. Okay. In an overall discount market. The red line's equilibrium. Here's our high. Here's our low. That's our range. Anything below this red line is a discount. So if we take out sell side liquidity in a deeper discount than this low is already at, we're expecting price to come back to the red line or above it into a premium, vice versa. Okay. And what that means is we're accepting that we're trading in a range. This is how you trade inside of a range. That's all I'm stating. Okay. So we're hanging out at equilibrium. What happens? Price breaks down below an old low, coming off of the equilibrium level. Look at the wicks right here, guys. Okay. They take out sell side. We're in a deeper discount now. We're not expecting the market to draw all the way down here because this is the range low. We're not expecting a breakout. We are in a consolidation. So we have to trade the market as such. So after we take out this sell side liquidity here, what are we expecting the market to do now? Come back to this red line at minimum. There's no reason for the market to keep going lower because this is the range low down here. There's no reason for price to drop below here because we already determined we're in a consolidation. That doesn't mean you go into this market and start buying right here blindly. You want to see the other time frames start physically creating and physically respecting your bullish time frames or your bullish PD arrays, okay, on your favorite time frames. The next candle opens up. We trade below that candle's low one more time. There's your turtle soup. You want to go in there and try to visually look for your low risk buy. Okay, if you missed that, that's okay. But we're looking for signs that confirm and give us the green light to go ahead and start buying this pair now to come back to equilibrium. Okay, so when this happens, let's go ahead and break this down to a daily now. We're unwilling to make any lower lows. That's when you want to start looking for your SMT with the dollar index. Okay. We're unwilling on euro to make lower lows. I believe on dollar, they made a higher high, which would give you SMT divergence on these higher time frames. Look up. We want to look for opposing bullish PD arrays now. Not bullish PD arrays. We want to look up for opposing premium PD arrays. Okay. You can draw your fib from this swing high here down to the swing low. Anything above this 50% level here is a premium PD array. We all know what our PD arrays are, correct? So what is this right here? It's a giant sell side imbalance. So we're expecting price to draw back to equilibrium. We see a giant sell side imbalance. So it's clear as day. We have the green light to look for buys now on euro. This is just the daily chart, okay? You can break this down into all the other lower time frames and go and find your own bullish PD arrays that got created and physically respected. But I'm just focusing on this daily chart for this example. We want our down close candles to act as support because we had just taken out sell side liquidity over here. We're in a giant discount of our overall trading range. And now we're looking to reprice back to equilibrium. Now we're looking to reprice back to opposing PD arrays. There's a giant sell side imbalance here on the daily chart. Here's our down close candle here. Prior to this displacement higher here on this green candle. This is your low risk buy, which is inside of this down close candle here. That's your low risk buy because if you draw your fib, it's the first swing OTE after the low got created. Here's your swing low. This candle is your swing high. This candle right here, this high. Price comes back to an OTE. It dips inside of the last down close candle here. prior to this displacement move higher. So there's your low risk buy on this daily chart. Are we below equilibrium? Yep, it's OTE, low risk buy. You buy that, even if you miss it, you're still okay. Let's say you did miss that. Where's your next one? Price creates a fair value gap here with this giant candle. I believe that was a major news event. They traded up inside of the sell side imbalance and then wicked back down below. The next day opens, they created a fair value gap, a bullish fair value gap. Okay. So what happens? They fill it. Look to the left. Where's your bullish order block? Right here. This last down close candle here, this red one. You guys know how I trade order blocks. I highlight the wick down to the body, extend it out in time. That's going to be my zone. So you're blending that with the bullish fair value gap as well. I'm going to go ahead and clean this up a little bit, though. We're going to get rid of this line, too. This blue line here is delineating sell side getting taken here. So let's go ahead and remove that now. So now we're looking for bullish signatures, and that's what we're doing right now together. Our first signature was the low risk buy, which was this swing low, OTE, bullish order block. We're expecting price to come up into this sell side imbalance and then equilibrium of our overall trading range, which is this red line. Also, what happens to be right at this red line? A swing high. So we're expecting price to come up and take out that swing high now because we are consolidating, and there's no reason for the market to come up here and not take out that swing high when in a consolidation condition, we are taking out swing highs. We are taking out swing lows of our overall dealing range, which was this high down to this low. The red line's equilibrium. And remember what I said at the beginning of the video? At the very beginning of the video, I said, go down to other time frames and note this red line and watch how the candles play with that level, okay? But anyways, so the wick to body of the bullish order block blended with the bullish fair value gap. Here's your next entry to go long. What do they do before they expand higher again? They turtle soup. They sure do. Turtle soup. They take out this candle's low and then dip down into the zone. The zone is not made up. It's a zone I drawn out before it happened. If you scroll down my Twitter feed, you'll see the before and after of this one. Again, like I said at the beginning of this video also, the markets consolidate just shy of their overall intended level. And then they turtle soup and dip down into their intended level. For this example, it was this bullish order block. They came short with the bearish candle. The next day opens, they turtle soup that low, trade into the daily bullish order block, and then they displace higher. And they close the day strong bulls. When that happens, that is what I mean by physically respecting bullish PD arrays right there. So your next near-term target should automatically be this candle's wick high. If you break this down right here, if we go ahead and break down all this price action right here, you'll see other stuff on lower time frames. We can do that, sure. But first things first, I'm going to note again our daily bullish order block. Let's break this down to a 4-hour. Hold on. How do I get this out of the way? I need. So this blue zone is our daily bullish order block, wick to body. Okay. Do you see anything else looking at this chart? I'll go ahead and point it out for you. Sell side liquidity got taken here. What happened? What caused that sell side liquidity to get taken? That was our first low risk buy right there on that daily chart. Swing low up to swing high. They come back to an OTE, take out sell side liquidity here. OTE, low risk buy, and then they blast off higher. Okay. There is a specific candle that caused price to come down, and that's this bullish candle right here. This bullish candle prior to this aggressive down move to take out sell side, that is your breaker. That's your bullish breaker. This candle right here. So we're blending a breaker with our daily order block, wick to body. That's what this zone is. Okay, guys? So yes, price is going to consolidate. They haven't come down to the breaker yet. They barely tapped the order block, which they might not have. We're not sure. But then the next day opens, that's when you look for your turtle soups right there. They're consolidating prior to hitting their main objective. Consolidation, manipulation, turtle soup, take out sell side, then they stab into the daily order block, and then they stab down into the 4-hour bullish breaker. But look how fast they do it. You want to see manipulation happen fast. Michael would always teach, ICT would always teach the London Open manipulation would occur right before London Open, around 1:30 to 2:30 a.m. New York time. You're going to see, majority of the times, you'll see price move pretty aggressive, the wrong direction first. And then throughout the day, price will go the opposite way. Same thing here. This down close candle here, this red one, look how aggressive it was to dip down into our overall main objective, which was that daily bullish order block. If you take the absolute low on the bullish candle, look what it did. Look what it hit. The breaker. Take it to the bodies of the candles. The bodies. Right there at the breaker. The last up close candle here prior to taking out sell side here. Before all this happened, if you look left, look here. You want to see bullish PD arrays get respected. If you look over here, price trades lower, stabs down into this last down close candle prior to the aggressive up move, which is a bullish order block. They respect that and then trade higher. So we're seeing bullish arrays get respected. Okay. So there's no more other obvious targets than higher price action. If you look at price now, what do we have over here? A low resistance liquidity run up here. So we know without a doubt, price is looking to trade higher. And yes, you're going to see turtle soups at these levels. It's nothing new. It's been happening. I mean, it is what it is. If you can't see it, then you're just blind. Let's go ahead and remove all of this. So here's the concept y'all are trying to say is new. Oh, here's the down close candle. Oh, candle range low, candle range high. No, that's not it at all. It's a bigger picture than that. Okay, but anyways, so prices respecting that daily bullish order block. We're seeing respected bullish price action. So our clear objective is here now. And then obviously our red line, which was equilibrium, which is here. And this candle's high just so happens to be, no, I guess not. We need to notate our equilibrium level. I accidentally took that off. Sorry. low to the high. Let's put our line back on for equilibrium. And there's equilibrium. Okay. I didn't mean to take that one off. So we're seeing respected bullish PD arrays. We have the turtle soup below this low here. They dip down into our bullish order block, and then we see price take off higher. And that was last Thursday, and that was during a news event. So you can blend high impact news with this higher time frame, and then everything comes together and blends together like a beautiful puzzle. Okay, we have the low resistance liquidity run up here, these two equal highs, and then price starts respecting bullish arrays. Power of three, the next candle opens, they trade down, fill in the buy side imbalance here, and then they keep it up higher. Where does price want to draw to? Again, price is wanting to draw to the red line, minimum. But the blue line was that weekly candle, candle range theory, whatever y'all want to call it. But it's a swing high in the market. That's all it is. So first, we identified what type of trading condition we're in, which we came to the conclusion we are in a overall consolidation. And when we're trading consolidations, we don't look for breakouts below the low or breakouts above the high. All price is doing is taking out sell side and taking out buy side and the discount and premium sides of this red line. So we're not expecting breakouts. So what do you think is going to happen when this old discount swing low here gets taken with one candle? We're not expecting them to come down here. So they're going to want to reprice back to premium, which is above this red line. What just so happens to be sitting right at that red line? This candle's high, which is a swing high on lower time frames. But we broke that down into these other lower time frames to confirm that bullish price action. And these were actually the setups. If you're a swing trader, this is how you could have traded this, the way I just described it. And yes, here's that fair value gap blended with the bullish order block again, just in case you missed it the first time. There it is. Then they turtle soup the previous day. They slam down into the zone, and then they impulse higher. When this daily candle closes, the next candle opens. What do? They trade down first to rebalance the bullish candle, and then they displace higher. It's just the PD array matrix. That's all this is, blended with the overall dealing range that we're trading inside of, which is the consolidation. But when we traded down here, below this old low, we're in a deep, deep discount. Well, what makes you think we're in a discount? I already told you, because our dealing range is this high down to this low. There's no other liquidity down here, okay? So there's no reason to go any lower. But the exact low, if you look left, every time you see a swing low or a swing high in the market, you always want to look left, because 9 out of 10 times, there's going to be a reason that price stopped where it stopped, okay? And I actually called this one out too in my commentary about a month ago. Price looked like this. Let me go ahead and show you. When price was right here, I had this low notated. What is resting below this low? Well, if you look even lower, we have this low over here as well. But if you look even lower than that, we have this bullish fair value gap right here. Now, if I hit play, tell me where the market went down to and stopped. Right there, stopped on a dime. That was the swing low. This bullish fair value gap. I'll zoom into it for you. Right here. This candle's low. This candle's high. The candle in the middle creates the fair value gap. That was the exact low before we traded back up to the sell side imbalance here, and then equilibrium, and then overall the swing high. So there was absolutely no reason for euro to go any lower than this because we took out all sell side, we filled in all PD arrays, which for this example, they came down to this exact array here. There was no reason for euro to attack this area right here. Why? Because that's the yearly low. We're trading in a consolidation. We don't call breakouts. So that's why they stopped here and then started respecting bullish PD arrays. Now we're looking for opposing liquidity. Now we're looking for opposing premium PD arrays to target. And then that's what we just broke down. Beautiful stuff, ain't it? It's my first video in a while. I know I repeated myself a lot, but hopefully you were able to gather some new information. I just wanted to show you guys how to trade consolidations, what the market, I wanted to tell y'all what the market is wanting to do when you're inside of a consolidation. Always remember, note that equilibrium level, and always remember where you're at in the overall spectrum, in the overall grand scheme of things. Where is the market trading from? What's it most recently done? But yeah, this was the logic for euro over the last couple weeks. It has nothing to do with candle range theory. It just so happens to be the markets love to take out old highs and old lows. Like, you got to be a fucking idiot to really support CRT. Just saying. You got to be pretty fucking stupid. But good job, Romeo, for damn manipulating and scamming thousands of people. I will say that. uh, anyways, everything I just talked about on euro, you can flip the script with the dollar index. Low, high, overall consolidation, right? Right. Where's the market looking to draw back to now? It was in a giant premium way up here. We're not expecting it to go up higher and take out these highs over here. Why? Because we're in a consolidation on the monthly time frame. We're expecting price to come back down to the red line. The red line is equilibrium. I'm sure 90% of you probably thought dollar would take out these equal highs. There was no reason to go above these equal highs because this is a huge premium. The next blue line up here is the yearly high. We already identified what type of market condition we're in, which is again, consolidation. This is a huge premium. Well, there you have it. I'm a little rusty teaching right now. It's my first video I've done in a long time. So I'm trying to get back in the groove of stuff. But anyways, if you were able to sit through all that and learn something, please just give it a like, give it a repost, retweet, whatever you want to do. I'm not hating on anybody. I was simply just stating facts. Once you see the market for really what it is, and you can look at it on your own the way I just did it, it becomes beautiful. It really does. Anyways, I will see y'all later. Peace.